Guys, this is Dan French, and I'm here with Angelina Casiello. She's from Radian Mortgage Insurance. This is a sequel. It's another episode on mortgage insurance. This is the second part, and we're going to talk today about really the 4 different varieties of what mortgage insurance has to offer, the different varieties of insurance companies and ways you can get insurance, and also we're going to talk about the misconception of how much down payment you really need. I think a lot of people think you need 20% down. That's not true. Obviously, she's going to go over the facts on this. So with further ado, we got Angelina Casiello. She's with Radian Mortgage Insurance. And so let's talk a little bit about, first off, about what people think about 20% down versus why do I have to have mortgage insurance? You know, I have a lot of clients come to me and say, you know, do we need 20% down? And I'm like, no. And the reason why is because mortgage insurance comes in and saves the day. So talk a little bit more about that.
Yeah, so I think I hear that a lot, and it's interesting because I work with lenders. I do business to business working with lenders and insuring the banks, but I'm all the time out there talking to different consumers and buyers, and a lot of times they say to me, do I need 20% to save for a house?
Yeah.
Absolutely not. The beauty about mortgage insurance is that you can get into a house with as little as 3% down.
3% down, that's amazing.
Yeah,
right?
and so it gives you the ability to earn equity right away instead of saving for 20%, because on the average income to save for 20% down payment, that could take you 10, 12 years, and by the time you save that money, the prices of houses have gone way up.
We talked about a lot of countries ask 20 to 40% down.
Yeah.
You know, because they just want to make sure that they're not going to have a default on that mortgage. So being an American and having these options is something that's a perk and it's a privilege, right? And so you have to take advantage of that, but you also have to understand that mortgage insurance, yes, you're not getting a return on that, but you might not be able to get into a home at all if you didn't have that in place.
Yeah, I do hear a lot of times people say, I don't want to pay that stupid PMI, what do I get out of that? And what you get is you get the ability to buy a house instead of having to wait, which is beautiful. And a lot of people realize there's not a whole lot in it for them per se, because mortgage insurance is there to protect the bank. It gives the bank the ability to lend money without having a big down payment, because if the borrower decides that they don't want to pay their mortgage anymore and they want to walk away, what is the bank's job? The bank's in business to lend money.
Sure.
They don't want to be a landlord. They don't want to own houses. So the mortgage insurance there is to protect them in the event that the buyer walks away. They can be whole again. They can continue to do their job, which is to lend money.
So there's a lot of clients that are saying, for instance, I just had a person that was doing a refinance with me, and they were just a little bit short from not having to have mortgage insurance on their loan. And so what we did is we did a single paid mortgage insurance, which would require the borrower to pay a lump sum of money, but guess what? He wouldn't have to have mortgage insurance on his house. So can you kind of go over the varieties of what mortgage insurance there is?
There's a couple different options, and the most common one that you see is monthly. So a lot of times people don't have that extra money to put down when they buy their house. They might be just putting together 3 to 5%. So they'll go with monthly. So monthly mortgage insurance is based on a number of different factors. I like to compare it sometimes to car insurance, because we all know if somebody's a bad driver, they're going to pay more for their car insurance. Same thing when it comes to private mortgage insurance. If you've got great credit, you're putting more money down, you've got lower debt to income ratio, you're going to get a benefit for that in conventional financing. If you're a borrower that maybe doesn't pay all your bills on time and you're higher risk, it's going to cost you a little bit more. So that's across the board for any type of mortgage insurance. But to your question, there's monthly, which is most common, and then there's a lump sum. So you can always pay a lump sum, not always. Usually you're higher.
In some cases, right?
Yeah.
It's dependent on the situation with the client.
But this is why it's important to work with a good loan officer that understands these things. So I appreciate that you take the time to learn this.
And here's the thing, how many people really know that what private mortgage insurance is on your, as far as going out there in the field? You talk to a lot of people. Is there really a lot of people that really are like, hey, you know what, I know who Radian is, right?
Some. I mean, I would say borrowers don't, because I'm more business to business working with loan officers, and there's good and there's bad out there in any field, so it's always good to work with somebody that's a professional and I think takes pride in learning more.
And here's the thing about that, there's a big difference between private mortgage insurance, which that's what she is. She's there to protect the bank. versus hazard insurance, which is something a consumer shops for, and they use that to, in case the house burns down or you guys, there's a water leak or something, so you can shop that. Now, you could shop this as well, but it's really a little different on how they shop hazard insurance, which is in case the house has an issue, versus protecting the bank, correct? And a lot of it's credit score driven, right?
Yeah, it's definitely credit score is a big factor, but there's multiple different layers of risk that you can have in a loan.
Okay.
So you've got your credit for one, you've got number of borrowers, so if you've got an extra person on the loan, you may get a lower premium because that's two people that are on the hook for the loan. Things like debt to income ratio, so how much money you make versus how much money goes out. So if you have more money going out versus how much you make, that's riskier because if hard times come, who's going to be more likely to default on their home loan?
Okay, so the single biggest factor that somebody should take away from a conversation like this about mortgage insurance, if you're a consumer out there, you're in the market, you're green, you're just getting ready to buy a home, and you're just trying to get all the factors and get all the data out there, what is the single most important thing that they can take from understanding what mortgage insurance is, and how does that affect them?
I think mortgage insurance is more of your friend, and it has this bad reputation of, I don't want that, there's nothing in it for me, but what's in it for you is you always are going to need a place to live. And if you had to wait to save up for 20% down, it's going to take you a long time.
Yeah.
So if you
think about this.
Now,
Banks will not lend unless you have 20% down, unless mortgage insurance is in place, correct?
Correct. I mean, you still have mortgage insurance if you're going FHA.
Right.
And FHA definitely is very valuable, but conventional has the reward that mortgage insurance can be canceled. FHA is going to be for the life of the loan. With conventional, you actually don't have to refinance to get out of mortgage insurance.
Okay.
And we can talk about that too.
Does the mortgage insurance go down as you pay your mortgage down, right? So like if you're in your house for 15 years, obviously the loan amount is less, so the insurance amount is less too, is that correct?
Yes, it will decline.
Right.
Yes.
And at some point, there's a period where you can even look to see about canceling it, but let's just say you have it, the homes didn't appreciate as much as they wanted to, or for whatever reason. You can always consider removing it, but as it goes down, the big thing here is as the mortgage goes down, so does the amount of insurance you pay.